Why owning real estate is like having your personal gold mine. One of my favorite investments is a real estate asset. Why? Because there are a ton of tax benefits that go along with it. First of all, you're running your own business. You have either a single family or multifamily home or even a commercial property, and you get to reap all the rewards from it. My personal favorite is tax-free cash flow. Well, the question is, how do you even get to that? When you own real estate, there's certain provisions in the tax code that allow you to take massive deductions against the income. One of the biggest things is depreciation, but there's a step further to depreciation. Now, the way you depreciate a building, for example, is either over 27 and a half years if it's residential, so a single family or multifamily home, or over 39 years if it's a commercial property. If you have a store or if you have retail and other professional office tenants, that would be a commercial building. In addition to the flat 39 or 27 and a half year deduction for depreciation, you can take it a step further and perform what's called a cost segregation study. Because in that building, I guarantee you, there are certain items in there that will qualify for a shorter depreciable life. Well, you have assets such as cabinetry, lighting, carpeting, and you may even have some land improvements outside. These fall into a smaller useful life category, such as 5, 7, or 15 years, instead of the 27 and a half or the 39-year depreciation life of the actual building. You can shorten the useful life and increase your deduction. And that's where you get a lot of that tax-free cash flow, because the expenses are gonna be greater than the income coming in. This is what we call paper losses, but cash in your pocket. Another benefit is appreciation. This is a long-term play. You're gonna buy this asset and you're gonna hold on to it for 5, 10, 15 plus years. Some assets are held intergenerationally, so you can pass these down to your kids. And the benefit of this appreciating asset is that you can also tap into the equity of the asset and do what's called a debt finance distribution or cash out refinance, where you actually refinance the original loan and you take out the cash from the built-in equity that you have. Let's illustrate this. You buy a house for $500,000, you fast forward 7 years, and now that same house is worth $1 million. When you bought it, you did a traditional loan. You put 20% down, so you put $100,000 down, and you took a $400,000 loan from the bank. Now, we fast forwarded 7 years, that asset is now worth $1 million, market value, and the loan was paid down, and now the mortgage remaining on that property is no longer $400,000, let's say it's $325,000. Now, you have a huge built-in equity gain in this property. We're looking at $1 million less $325,000. So now you have $675,000 sitting in this property that normally you can't touch, but you can refinance that loan. So you knock on Mr. Banker's door and you say, Mr. Banker, I have an asset worth $1 million. The mortgage on this property is at $325,000. I'd like to tap into the remaining equity. Most likely the banker is going to say, that's great. We'd be happy to give you that equity, but we can't give you 100%. We'll give you a loan to value of 80%, which is pretty common. So they can loan up to $800,000 on that property for you, which gives you an extra $475,000 that you can take out on top of the original loan that you can do whatever you want with. What are the things that you can do with it? You can buy additional property, or you can take it out and use it for yourself. May not always be the best decision, but sometimes you do need to tap into that equity for other debt that you have, for other business ventures that you wish to pursue. That is there. Now you're gonna say, hold on a second. In this environment, why would I refinance a loan that I took 7 years ago at my 3% rate and go into a 6.79% today? Now I'm gonna say, you're right. We may not necessarily wanna do that, but it all depends on what you're looking to purchase. And on that note, we can look at another benefit, which is a tax-deferred disposition or a 1031 exchange. You can catch the link here. And with a 1031, you're essentially exchanging your rental property for another rental property, and all the gain that's built up in that transaction is actually rolled into the new asset. Same example, we bought this property for $500,000 and 7 years later, it's worth $1 million. And there's an opportunity that you can actually get down the street. It's a distressed seller. They're looking to sell their multifamily property with 4 doors, you have one with 4 doors for $1 million. And you say, that's a no-brainer. Where do I sign up? And they say, right here, I just need $1 million. You say, okay, let's do it. No problem. You're gonna agree to the sale, you sell your property, you buy the new one, and the gain gets carried over to the new property. The way to really look at it is that the cost basis in your new property is essentially decreased by the gain that you would have recognized. You still get to depreciate the property at the fair market value, but when you dispose of the next property, meaning the one that you just bought, then you're gonna pay the tax on the future gain and the gain that you just deferred. But here's another little secret. You don't have to ever sell the property. You can actually keep doing 1031 exchanges until you die. And here's another amazing loophole. When you die, your property gets passed down as an inheritance to your children or next of kin with a stepped up basis. Whatever the value of that property is, that's going to be the fair market value to your kids. That $1 million property that you bought today, let's say you don't do any more 1031 exchanges, 25 years later, that property may be worth $10 million. Your kids are going to get that property at a $10 million valuation, and whatever deferment you had over the years disappears. And another amazing benefit, depending on your income level, let's say this property is operating at a loss, you actually get to deduct up to $25,000 of losses, which are usually in the passive category, against your ordinary income. Let's take it one step further. Let's say you have multiple properties and you're considered a real estate professional. Now there are certain rules that you have to meet in order to be considered a real estate professional, mostly to do with activity and how many hours you put in during the year, managing property, being involved in real estate, etc. And let's say you do, and your spouse either has a business or another ordinary wage. You actually get the benefit, if you're married filing jointly, to offset any income in the ordinary bucket that your spouse earns with any losses that you incur in your real estate profession. Thank you so much for watching. Make sure to like, follow, and subscribe for more tips. And if there's anything you want me to cover, comment below. I'm always looking for great ideas.